One of the most common questions I get is, Chris, why would we want whole life insurance instead of index universal life? So in this video, I figured I'd put together 5 different reasons that you would want whole life insurance instead of index universal life. And I think by the time we get to the end of this video, you're going to agree. So whether you sell index universal life or whole life insurance, or you're looking to buy for yourself, make sure you watch all the way to the end. Bear with me here. I'm sitting in a hotel room. Some of my equipment has malfunctioned. So I'm literally filming this in a way that I never have before. So hopefully it goes well. If you haven't already, subscribe, hit the bell, that way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and in this video we're talking about the 5 reasons that you want to buy whole life insurance instead of index universal life. And so let's just get into this, because I think this is going to be a controversial video for some people, because I think there's so much emotional confirmation bias when it comes to index universal life agents out there. And I think by the time we get through the end of this video, you're going to see what I'm talking about, and it's going to be pretty hard to debate the facts that I lay out on the table and some of the common sense when we get through the end of this. So let's go. Reason number 1, life insurance is and should be seen only as a savings product, not an investment product. And here's what I mean by this. So the difference between saving and investing is simply a function of risk, right? So when we look at it this way and we think about where are we putting our money and why are we putting our money there? Why am I saving or investing my money anywhere, and why am I doing it, right? And so when we look at this and we think about what is the profile of the company that's helping us achieve our goals, well, there are plenty of companies out there that can go help you take risk and achieve good returns, and that is what it is. That's not what life insurance companies do. Life insurance companies are masters. They're the best companies in the world when it comes to managing risk. So with that in mind, life insurance companies do one thing and one thing better than any company, any other financial institutions on the face of the earth, and that is they will get you the best possible return, managing the risk, beating inflation with the highest possible guarantees, right, without risking your money of loss. And that is what they do. That said, that is not how index universal life is sold, and that is ultimately not what index universal life does. So when you think about whole life insurance, it really is about being a savings alternative. IUL is sold as an investment alternative, but the bottom line is that's not what life insurance companies do. And by the time you get to the end of this video, I think you'll see what I'm talking about. So understand what role you need this product to solve in your life. And if you think about it and you go, I need a savings alternative, I need an emergency fund, I want an opportunity fund, and I'd like to have an additional supplemental fund in retirement, then whole life insurance would be a good product for you. Index universal life is not good for any of those. The second reason I like whole life insurance and not index universal life is because of the fact that whole life insurance can get paid up. IUL can never be paid up. What does that mean? Well, with whole life insurance, depending on how you want to structure it, there's a lot of different designs and whatnot that you can utilize with whole life insurance. You could do what's called a 10-pay, meaning that the payment is completely paid up. The policy is completely paid up inside of that 10 years. Now, here's the thing to think about. When we compare the two, IUL comes with a bit more flexibility on the illustrations and how you can kind of pay the premium or not pay the premium. That said, that flexibility comes at a lot of cost. And here's what I mean. I could go to an IUL agent and say, I want to only pay for 10 years. And they could show me an illustration with that payment only being paid for 10 years. That doesn't mean the policy is paid up. There are still charges that are compounding and growing and getting implemented and applied to the policy every single year until the day you die. Now, that doesn't seem so bad at my age at 42. Over the next couple of years, the cost of insurance will be controlled. It won't be too expensive. However, if my goal and how I'm using this policy and the goal of this policy is to utilize it for retirement income, I don't want to just think about how it's going to behave now. I want to think about how this policy is going to behave when I'm 75, when I'm 80. And this is my challenge with Index Universal Life, is a lot of people are buying these products and they're thinking about right now, but they don't realize how they're going to perform later in life. And ultimately, that's what matters most. It doesn't matter what this does right now. What matters is what an IUL is going to do in retirement for you when you need it most. And unfortunately, because of the fact that you can never pay up an IUL policy, you run into all sorts of problems. So let's look at two different potential scenarios. You take a whole life policy that is paid up at 65. Now, a lot of agents will say whole life is more expensive than IUL. It's not, because it's completely paid up. Is it more expensive up front? Absolutely, but it's cheaper over the lifetime of the policy. And I don't care, even agents that say, well, you're gonna reduce it to a level death benefit and all these things at retirement when you stop funding it, and therefore it's gonna make the cost of insurance go down. Doesn't matter, it's still gonna add up and be more expensive than whole life. That said, if you are utilizing whole life as what we would call a volatility buffer for retirement income to help make your other accounts better, and I've got other videos explaining what a volatility buffer is. It's one of the best ways to utilize whole life insurance as a retirement income vehicle to enhance all your other assets. If you're utilizing it like that at 65 years old, the good news is if you pay, you have the option, I should say, of paying up the policy at 65. If you choose to pay the policy up at 65, and that is what you do, when you start borrowing against the policy, that's less stress on that policy because it's completely paid up. There's no more insurance charges, no more admin charges, no more anything of that nature. The only thing you're gonna have to deal with is the expense of the loan management. Now, at that point in time, the policy would be mature enough. As long as the policy was funded and designed properly, you're never gonna have any problems. It's gonna be an amazing asset for you. And now when we flip to the other side and we take the same scenario, same variables, like we'll call it same way of funding, the same kind of design, relatively speaking, at 65, and then you start taking out those expenses or taking out that loan in retirement for utilizing the IUL, what's gonna happen is not only do you have to manage the loan expenses, but you have the annual renewable term inside of the policy. That annual renewable term is going to increase expenses, and it's going to get more and more and more expensive every single year you get older. That puts more and more stress on the policy above and beyond the loan stress. And because most people are utilizing indexed loans, which are variable, which means even on down years, that compounds the problem against you. This is one of the reasons why IULs are not good. You cannot pay them up. There's going to be constant fees every single year until the day you die. With whole life insurance, you can control those costs. Reason number 3 is surrender charges with the IUL are typically anywhere between 10 and 15 years. With whole life insurance, there are no surrender charges. The thing is, it's all about policy design. And when you look apples to apples and you design both policies relatively the same, whole life insurance is going to be more liquid, more quickly. And so if you want to utilize the policy for like things like real estate investing, which I do a lot of stuff with my cash flow hacking system and all the things that we do. That's why we utilize whole life insurance and not index universal life. It's a major reason. Because if you compare apples to apples, the whole life policy is going to be much more liquid due to the fact that it doesn't have surrender charges the way that IUL does. So reason number 4 that I believe whole life insurance is a much better product and why you should buy it instead of index universal life is because it's a more transparent product. What do I mean by that? I mean, a lot of IUL agents will say, well, whole life is not as transparent because they don't completely lay out what the costs and the fees and all these, what the cost of insurance are and the admin charges and all that stuff. They don't lay it out. Well, that's true. On an IUL, you can run an expense report. It will show you all the different fees and expenses, the cost of insurance. But what they don't tell you is that, or they do say, they actually do tell you. And what they tell you is that those are the fees currently. But if you look in the corner somewhere on the policy, there's going to be a little asterisk. And that asterisk is going to say, these are the current fees and they are subject to change at the discretion of the insurance company. With whole life insurance, they don't have to get as transparent with all the fees because it's already completely transparent in the illustration. There's 2 columns. There's a guaranteed column and there's a current illustration column. And the current illustration column is simply saying, how will this policy do with dividends being paid out as they are today? And the beautiful part about that for whole life insurance is that I am confident that the policies will outperform what you're seeing today. No guarantees, obviously, because we are near the lowest dividend rate environment that we've ever seen. Interest rates are going up. Therefore, in history, dividend rates have trailed, have lagged, have chased interest rates up. So in the next couple of years, I fully expect that dividend rates will go up. Therefore, the policy performance of whole life insurance will go up along with it, right? And so when you look at that, it's like, all right, that's transparent. Now, on the other side of things, IUL has all these pages on the illustration. Typically speaking, an IUL illustration is about 3 times longer than a whole life insurance. I've seen them even longer than that. And so when we think about Index Universal Life and how long it is, why are they doing that? Is because they have all these different supplemental illustrations that they put with it. They have all these disclaimers and legal jargon that are in there. Now, do you think they're making these legal disclaimers and making the illustrations longer for your benefit or for their benefit? I got news for you. It's not for yours. And so the lack of transparency in IUL is the fact that, you know, the fees are where they are, but they can completely control them, and they add in the legal jargon inside of the contract to basically just kind of take your eye off the ball and off the things that matter the most. So make sure if you do buy an IUL, make sure you spend the time, do your due diligence, read every single line, understand what you're getting into. But my guess is if you go through and you read every single line in an IUL contract illustration, you are not going to buy it. So the 5th reason that I think you should buy whole life insurance instead of IUL is because of common sense. Okay, I'm going to break a couple things down for you. So when you compare apples to apples, Index Universal Life to whole life insurance, let's use some common sense on a couple points. Commissions paid to the agent. IUL, apples to apples, at top contract levels, they pay 30 to 40% more commission on average than a whole life insurance contract when we're talking contract to contract. Now, there's obviously different levels of contracts. There's all things like that going on based on how experienced you are, how much production you've written, how much you've sold, and what level of an agent you are, and all these different variables. But I'm talking at the top levels that matter most because it all trickles down from there. IUL has much more compensation built into it. So when you look at it like that, how could they compensate the agent more yet also have the policy grow more? It has to do with control. And the fact is, the IUL companies are in control of the policy and not you, the policy holder. So that's the next thing on my list for common sense here is like, okay, if you had choices of 2 contracts that you could sign in any, take IUL, take whole life off the table. Let's not think about those 2 things. If you had 2 contracts in front of you that you could sign, and one contract said, all right, sign on the dotted line here, and as soon as you do, all the rights are for you here. The other party has all the obligations, all the responsibilities, right? But as soon as you sign on the dotted line, all the benefits of this are contractually yours and all the obligations are on the other party. That's a whole life policy. Now, the other contract is saying, as soon as you sign on the dotted line, the obligations are on you, right? And the other party, the insurance company, has the right and ability to change any feature inside of this policy within, not any feature, I shouldn't be so extreme. There are a lot of features inside of the policy that the insurance company can change or that the other party can change according to this contract at their discretion whenever they decide applicable. And it doesn't matter if it hurts how your policy is going to perform, how your side of the contract is going to perform. They can do so at your detriment if they need to. Which contract are you going to sign? Let's take life insurance out of the equation. Let's take whole life versus IUL out of it. If we just look at the 2 contracts and we look at the mindset and the common sense of which one do you want to sign, it comes pretty easy to figure out which one you want to sign. And then the next piece of common sense, and I've used this in several videos, but I think it's so important to understand, is that life insurance companies right now, commonsensically, if we really break it down, and they're earning about 4.5% in their general fund, and you understand how they use that 4.5% general fund to create an options budget, and they do all this, and I've got videos that break this down in more detail, but if they're getting 4.5% in their general fund, and they're being sold with illustrated rates between 5.5% and 7%, depending on the company, and they're telling you that they can do that predictably and safely over a long period of time, if they could do that, why are they not doing it for themselves? If They, in fact, can do this for you, and it's safe and it's predictable. After the cost of insurance, after all the fees and expenses, they can do that for you. Why would they not be implementing the same strategies in their general fund to increase the performance of their general fund and to increase their returns when in fact they wouldn't have any cost of insurance, they wouldn't have any expenses that go along with it, so their results should be better? Well, the answer is because it's all smoke and mirrors. They can't do it for them, so they can't do it for you. Remember, it goes back to the beginning. This is a savings alternative, not an investment alternative. Life insurance companies do not do well at getting great rates of return. They do an amazing job. They are the best in the world at getting safe rates of return, managing risk, getting you good rates of return on a guaranteed basis without risking your money, but it's all relative, right? Because you're not gonna get those benefits and still get crazy returns, and that's why the general funds in these companies are getting 4.5%. It's gonna beat inflation on a long-term basis. You're gonna have liquidity of that money, and it's just about expectation. It's about understanding what role you want this financial tool to play in your financial life. And when you think about it as an investment alternative, you're always gonna lose. Life insurance companies are never gonna get you there and never gonna get you the types of returns that you need in investment to get you to accomplish your goals. But everybody needs safe money. Everybody needs an emergency fund. Everybody should have an opportunity fund. Everybody, I believe, should utilize whole life insurance at some point in time in their life to solve these problems. Problem is when you start thinking about it in those terms, IULs just don't check the boxes, right? And so that's that. If you have any questions, those are the 5 reasons that I think when you break it down, whole life, it becomes a no-brainer, and IUL, you kind of just throw it away. It's not the right decision for most people. If you have any questions, comment in the comment section below. If you haven't already, make sure you subscribe, hit the bell, that way you're notified every time I launch a new video. Until next time, have a blessed, inspirational day. We'll talk soon.